SpaceX is currently preparing for a massive public debut that is projected to be the largest initial public offering in history. This chart visualizes the scale of that ambition. While Saudi Aramco set the previous record for IPO valuation, SpaceX intends to surpass it, aiming for a $1.75 trillion valuation and a record $75 billion capital raise. Traditionally, going public involves a specific fiduciary trade-off. Private companies gain access to massive public liquidity, but in exchange they surrender control to independent boards and thousands of new shareholders. SpaceX's S-1 registration statement is a legal innovation designed to break that trade-off. The draft documents outline a plan to extract that public capital while systematically stripping away the accountability that usually comes with it. Instead of entering the traditional public market, the company is transitioning toward a sovereign executive structure, one that operates without the friction of outside oversight. The most striking provision in the draft IPO filing is a mathematical one. Under the proposed and highly unusual rules, the chief executive officer cannot be removed from his leadership position without his own direct consent. Elon Musk is utilizing these novel corporate structures to cement his leadership as the company moves toward the public markets. This level of insulation is achieved through three distinct layers of protection: specialized share mathematics, specific regulatory exemptions, and a state-level legal moat. At a standard S&P 500 firm, a board of directors can fire a CEO with a simple majority vote if the business underperforms. That threat of removal is the foundation of corporate governance. The SpaceX S-1 treats those standard protections as structural inefficiencies, with the goal of creating a public company where leadership operates without traditional external friction. First, a dual-class structure. Public shares carry 1 vote, insider shares carry 10. This gives Musk 83.8% voting control, with only 42.5% equity. The public assumes the financial risk, but gets a fraction of the influence. This creates the removal paradox. The S-1 stipulates that the CEO can only be removed by a vote of the Class B holders, a group Musk personally controls. That same voting bloc gives him the unilateral power to elect, remove, or fill any vacancy on the company's 9-member board of directors. To prevent this power from diluting over time, the filing includes a consolidation mechanism. If Class B shares are sold, they convert to Class A, ensuring that voting power remains concentrated within the original circle of insiders. The capitalization table effectively acts as a primary firewall, rendering any traditional shareholder vote on leadership or direction entirely symbolic. By holding over 80% of the voting power, SpaceX can designate itself as a controlled company under federal securities rules. This status grants the company significant exemptions, most notably the ability to bypass the requirement for a majority independent board of directors. SpaceX has stated it does not plan to maintain independent committees for nominations or executive compensation. The leaders making decisions and the board overseeing them will be essentially the same group. This has allowed the board to establish compensation milestones tied to non-financial targets, like a 1 million-person Mars colony or space-based data centers, goals that have no parallel in the history of the public markets. This structure targets a specific legal pain point Musk experienced at Tesla, where a Delaware court voided his $56 billion pay package because the board was deemed non-independent. Without independent friction, the company can more easily engage in massive related party transactions, like Tesla's recent $2 billion investment in SpaceX, or the all-stock acquisition of the startup xAI. By utilizing this regulatory bypass, the internal check of a board is removed, leaving leadership to answer only to itself. To protect the company from external challenges, SpaceX reincorporated from Delaware to Texas in 2024, placing itself under a new and largely untested legal code. This funnel illustrates the impact of the Texas Business Organizations Code. A new rule requires shareholders to hold at least 3% of all outstanding stock just to maintain the standing to bring a lawsuit against management. At a $1.75 trillion valuation, a shareholder must hold over $52 billion in stock simply to be allowed to sue for a breach of fiduciary duty. For smaller claims, the S-1 includes a mandatory arbitration clause. This forces all federal securities claims into private proceedings, stripping away the right to jury trials. In Delaware's Public Court of Chancery, judicial reviews are transparent and can set legal precedents. Mandatory arbitration keeps these disputes private and prevents shareholders from grouping together in class action lawsuits. These combined rules effectively close the courthouse door to most retail and institutional investors. This legal moat ensures that even if internal governance fails, there is no viable external mechanism for shareholders to seek legal recourse. These provisions have sparked a protest from institutional investors, representing over $1 trillion in assets. The signatories include some of the nation's largest public fiduciaries, including the CEO of CalPERS and the New York City Comptroller. Their letter warns that the proposed IPO structure is novel and extreme, specifically challenging the Texas law barriers and the mandatory arbitration of shareholder claims. However, these funds are trapped in a passive capital paradox. Because SpaceX is poised to be so large, major equity indices must include it. Many pension funds are forced buyers of the index. They cannot divest from SpaceX over governance concerns without failing their mandate to track to market. These funds are required to take on billions in economic exposure while accepting what they describe as a meaningful diminution of their legal rights as owners. This creates a captive capital market. The largest owners of the company have the least amount of leverage to demand oversight. SpaceX has used the structure of modern passive investing to ensure a constant flow of capital that remains detached from governance quality. Governance experts warned that the SpaceX S1 could become the new baseline for future IPOs in the technology and artificial intelligence sectors. High-growth firms like Anthropic or OpenAI may look to this model as a way to access public markets without accepting public interference. The federal government facilitated this shift. In 2025, the SEC reversed a long-standing position, explicitly allowing the mandatory arbitration policies that SpaceX is now using. This shifts the balance of the public markets. Voting power is being decoupled from economic risk, turning the largest investors into silent partners, while cementing a system of founder sovereignty. Capital in the highest tier of the market is being permanently separated from the power to direct how that capital is used. The three layers of the S1, the math, the bypass, and the moat, combine to create what one critic described as a total lack of accountability. The counter-argument is that Musk's track record of technical achievements justifies the lack of oversight. For many, his ability to achieve the impossible is worth the removal of corporate friction. Investors are ultimately being asked to accept the loss of traditional rights as the price of entry into a business with a projected $7 trillion upside. In this model, buyers are not investing in a company with a board or fiduciaries. They are investing directly in the vision of a single individual. In the SpaceX IPO, public capital provides the funding for a company where executive control is absolute, and the mechanisms intended to check that power have been systematically disabled.